what banks do with your money and why you should do the same. Did you know that banks make big profits off your money, frequently without your knowledge? You could believe that your money is simply sitting in your account, unaffected, yet this could not be further from the truth. Banks use your savings to support a massive wealth-generating system for themselves. Have you ever wondered what happens to your money once it is in the bank? This video will explain how banks utilize your money for growing their wealth, and more significantly, how you can use those same tactics to grow your own riches. So if you're ready to stop letting banks to benefit only off your hard-earned money, keep watching. It's time to put your money to work for you. What happens to your money at the bank? When you put money in a bank, you might believe it is just held there, waiting for you to come and take it. In truth, banks utilize a mechanism that allows them to actually use your money rather than merely storing it. When you make a deposit, banks maintain just a little portion of it as reserves, just enough to cover urgent withdrawal requests from other customers. The majority of your deposit does not remain still. Instead, money flows into the economy, fueling loans, investments, and other income-generating activities. This method is known as the fractional reserve system. In essence, banks simply keep a portion of their deposits on hand, often about 10%, and utilize the remainder to sustain their commercial operations. Banks use the money they keep in reserve to engage in what's known as the banking multiplier effect, which involves lending out a considerable amount of each deposit numerous times. This enables them to produce significantly more credit than they actually have in physical money, thus doubling money inside the economy. A bank may lend 5 or 10 times the amount you deposit, resulting in a constant flow of cash and credit. Banks use the fractional reserve system to maximize every dollar deposited. This means that when you deposit money into a bank, it doesn't simply remain there, it becomes part of a much bigger financial ecosystem. Because clients trust the banking system's security, banks may produce significant revenue while retaining only a small reserve. How banks generate money from your deposits. 1. Lending and loan interest. The primary method banks make money from client deposits is by issuing loans. Banks do more than merely keep deposits. They also lend them to individuals, corporations, and other organizations. Loans for mortgages, cars, business finance, personal loans, and even credit cards all use a portion of deposited funds. In exchange of offering these loans, banks charge interest, which is a key source of revenue. For example, if you put $1,000 in your bank account, the bank may lend a significant percentage of that sum to someone seeking a house loan. The borrower will repay this loan over time with interest, and the bank will benefit from each installment. Banks generally pay a low interest rate on deposits, but offer considerably higher interest rates on loans, creating a profit margin. Over time, loan interest accumulates, providing the bank with a constant source of income. 2. Investment portfolios. Beyond lending, banks invest a percentage of their deposits in a variety of assets to diversify their revenue streams. Banks create investment portfolios that comprise government bonds, corporate bonds, equities, and real estate. These assets yield returns in the form of dividends, capital gains, and interest income. Because banks have huge amounts of money, they may invest extensively in these sectors, typically with reduced risk and access to high-yield possibilities that the common investor does not have. For example, government bonds give a consistent income with little risk, but corporate bonds and equities may provide bigger returns with moderate risk. Banks also engage in real estate, both as physical assets and through financial instruments such as mortgage-backed securities. Banks develop a diverse portfolio by spreading out their investments, which protects against economic downturns while still earning huge revenue. 3. Fee structures and account-based fees. Banks also make money by charging clients fees for certain services. Every time you pay an overdraft charge, transaction fees, account maintenance fee, or ATM fee, that money goes directly to the bank. These fees may appear small individually, yet they may add up to billions of dollars in income for banks. For example, account maintenance fees may apply to checking and savings accounts if customers fail to meet certain requirements, such as maintaining a minimum balance. Banks charge overdraft fees when customers withdraw more money than their account balance, which generates considerable revenue for the bank. Transaction fees may apply for transferring funds, paying bills, or using out-of-network ATMs. Banks set these fees to generate consistent revenue regardless of economic situations. Account-related fees may be relied on to bring in revenue even when loan demand is low or investment returns fluctuate. Why you should use these strategies too. If banks can make use of your money to build wealth, why couldn't you do the same for yourself? Using the same concepts of leverage and investment, you may create your own wealth building strategy that increases over time. First, let's discuss leverage. This doesn't mean carelessly accumulating debt. Rather, it entails using the borrowed money responsibly to access investments that might yield profits. For example, taking out a mortgage to invest in real estate might be considered leverage if the property appreciates over time. This technique enables you to take control of a larger asset with a minimal initial investment, making it easier to build up wealth as the asset appreciates. Real estate and stocks are wonderful places to begin your financial journey. Real estate, whether residential or commercial, may generate consistent profits through rental revenue and property appreciation. Similarly, the stock market allows you to hold shares in lucrative companies. To balance your portfolio, diversify between both conservative and higher risk assets, just as banks do. For example, buying a combination of dependable dividend-paying stocks and growth stocks allows you to reap both immediate profits and long-term appreciation. This technique is similar to how banks develop balanced portfolios that provide growth potential while managing risks. Another important aspect of wealth creation is developing passive income streams, sources of revenue that do not require daily work to sustain. Banks generate passive income from interest and investments, and you can do the same with dividend stocks, rental properties, and peer-to-peer lending platforms. Reinvesting profits and taking advantage of compound interest can help your initial investments increase tremendously over time. In summary, by generating multiple sources of income and reinvesting earnings, you may create a self-sustaining system that passively builds your wealth, similar to how banks work. Practical ideas for getting started. Are you ready to start using these tactics yourself? Start small, with investments that are within your budget and comfort level. Consider allocating a modest portion of your salary to invest in stocks, bonds, or mutual funds. This allows you to start creating a portfolio without taking on too much risk upfront. Even small deposits may increase dramatically over time thanks to the power of compounding. So the sooner you start, the better. Next, look at low-risk lending choices such as peer-to-peer lending platforms or bonds. These investments allow you to generate a consistent income stream while minimizing risk. Platforms like this connect you with individuals or businesses looking for loans, allowing you to earn interest exactly like banks. While returns may be lower than in higher risk investments, they provide stability and predictable income. Finally, diversify your investments in the same way that banks do. Combine conservative investments like treasuries or blue chip stocks with growth-oriented assets like real estate or technology stocks. Diversification not only saves you from large losses if one sector suffers an economic setback, but it also increases your chances of long-term success. A diversified portfolio, similar to how banks diversify their assets across asset classes, can help you weather economic swings and steadily grow your wealth. Well, there you have it. If you found these ideas useful, be sure to subscribe for more wealth building tips. Thanks for watching.